Let me ask you something. If you own gold or silver right now, do you actually understand what's about to happen in the next 90 days? Because what I'm seeing in the data suggests we're approaching a moment that most precious metal holders are completely unprepared for. And I'm not talking about some vague prediction or hopeful thinking. I'm talking about specific mechanisms already in motion that are going to force a repricing of these metals whether anyone's ready or not. Here's what caught my attention last week. The COMEX reported something unusual in their delivery data. We saw 47,000 contracts stand for delivery in gold futures. Now, if you're not familiar with futures markets, let me explain why that number matters. Typically, only about 2 to 3% of futures contracts actually result in physical delivery. Most traders just roll their positions or settle in cash. But 47,000 contracts? That's 4.7 million ounces of gold that people are demanding in physical form. At current prices, we're talking about $12 billion worth of metal that needs to leave the vault and go into someone's possession. The COMEX has roughly 8.5 million ounces of registered gold available for delivery. Do the math. If this trend continues for just 2 more months, they've got a problem. And it's not just happening in gold. Silver saw 8,200 contracts stand for delivery last month. That's 41 million ounces. The registered silver inventory at COMEX? About 48 million ounces total. Now you might be thinking, they'll just bring in more metal. Except here's where it gets interesting. The premium for physical gold over paper gold has been widening. In London, physical bars are trading at $15 to $25 over the spot price. In Asia, that premium jumps to $40 to $60. Why would anyone pay more for the physical metal if there's plenty available? They wouldn't. These premiums are telling us something critical. The physical market is tighter than the paper market suggests. Let me take you back to a moment in history that rhymes with what we're seeing now. March 1968. The London gold pool was collapsing. For 7 years, central banks had been working together to suppress the gold price at $35 an ounce by selling their reserves into the market whenever demand picked up. The United States was leading this effort because foreign governments were starting to exchange their dollars for gold, and the U.S. gold reserves were hemorrhaging. In the first 3 months of 1968, the pool lost 1,000 tons of gold trying to defend that $35 price. On March 14, 1968, they gave up. The London gold market closed for 2 weeks. When it reopened, there were 2 prices, an official price of $35 for central bank transactions and a free market price that immediately jumped to $44. Within 3 years, Nixon closed the gold window entirely because the game was over. The physical demand had overwhelmed the paper promises. What's happening right now has that same energy. Central banks bought 1,037 tons of gold in 2023. That's the second highest annual purchase on record. But here's the part that should make you sit up and pay attention. They're not buying from the COMEX or the LBMA. They're buying from each other, through bilateral deals, outside the traditional market structure. China bought 225 tons last year through official channels, but analysts who track import data through Hong Kong estimate the real number is closer to 900 tons. Russia added 200 tons, Turkey added 148 tons, India added 100 tons. These aren't small players making speculative bets. These are sovereign nations with trillion-dollar economies making strategic decisions about what they want to hold as reserves. And they're doing it quietly, consistently, month after month, regardless of price. When central banks behave this way, they know something. They're not trying to make a profit on a trade. They're preparing for a structural change in the monetary system. Meanwhile, look at what's happening with the US dollar. The dollar index has been strong, which traditionally would pressure gold prices down. Except gold isn't behaving that way anymore. It's holding above $2,600 an ounce even with a strong dollar and rising interest rates. That's not normal. Gold is supposed to fall when the dollar rises and when interest rates go up, because the opportunity cost of holding a non-yielding asset increases. But it's not falling. It's consolidating at elevated levels, building energy for the next move. Why? Because the relationship between gold and the dollar is changing. For decades, gold was priced in dollars, and the dollar's strength or weakness drove gold's direction. But we're entering a phase where gold is being repriced based on its role as a monetary asset independent of the dollar. The BRICS nations are working on a trade settlement system that uses gold as a reference point. It's not a gold-backed currency in the traditional sense. It's more sophisticated than that. It's a mechanism where trade imbalances between nations can be settled using gold-linked instruments, bypassing the dollar entirely. Saudi Arabia just announced they're open to settling oil sales in currencies other than dollars. That's a seismic shift. The petrodollar system has been the foundation of dollar dominance since 1974. If oil can be purchased in yuan, rubles, or rupees, with gold as the settlement mechanism for imbalances, the demand for dollars drops. And when demand for dollars drops, all those dollars that have been sitting in foreign reserves for decades start looking for somewhere else to go. Where do they go? Some will go into other currencies, some will go into real assets, and a significant portion will go into gold. Not paper gold, physical gold. Because when you're a central bank or a sovereign wealth fund managing hundreds of billions of dollars, you want the actual metal in your vault, not a promise from a bank that they'll deliver it someday. This is creating a two-tiered market. There's the paper market, where prices are set by futures contracts and ETF flows. And there's the physical market, where actual metal changes hands. Right now, the paper market is still dominant. It sets the price that everyone sees on their screens. But the physical market is starting to decouple. Those premiums I mentioned earlier? That's the decoupling in action. The paper price says gold is worth $2,600. The physical market says it's worth $2,640 in London and $2,660 in Shanghai. What happens when that spread widens further? What happens when the premium for physical metal goes from $40 to $100 or $200? At some point, the paper market loses credibility. People stop trusting that they can convert their paper claims into physical metal at the stated price. And when that trust breaks, the paper price becomes irrelevant. The only price that matters is what someone will pay for metal in hand. We saw a preview of this in March 2020. When COVID hit and the world locked down, the gold futures market went haywire. The spread between futures and physical exploded to over $100 an ounce. Why? Because the logistics of moving physical gold broke down, refineries closed, flights were grounded. The metal couldn't get from London to New York to settle the futures contracts. For a few weeks, the paper market was trading at a massive discount to physical because nobody trusted they could actually get delivery. The system patched that problem by airlifting gold across the Atlantic and adjusting the delivery specifications for COMEX contracts. But it exposed the fragility. The whole structure depends on the ability to move metal around quickly to wherever it's needed. If that flow gets disrupted, either by logistics or by hoarding or by export restrictions, the paper market seizes up. Now, let's talk about what this means for you if you own precious metals. First, understand that not all gold is created equal. If you own shares in a gold ETF, you own a claim on gold that the fund holds in a vault somewhere. You don't own the actual metal. You can't take delivery of it. You're dependent on the fund's ability to maintain that gold backing. Most of the time, that's fine. But in a scenario where physical demand overwhelms supply, ETFs can face redemption pressures that force them to sell metal at exactly the wrong time. If you own physical gold or silver, coins or bars in your possession, or an allocated storage where you have specific serial numbers assigned to you, you're in a much stronger position. You're not dependent on the paper market's integrity. You have the actual asset. But here's something most people don't think about. Where is that metal stored? If it's in a bank-safe deposit box, what happens if banks limit access during a financial crisis? If it's in your home, is it properly secured? These aren't paranoid questions. They're practical considerations for anyone holding significant value in physical form. And speaking of retirement accounts, if you're sitting on $100,000 or more in a traditional IRA or 401k, there's something you should know about. You can actually hold physical gold and silver inside a retirement account through what's called a gold IRA. It's a self-directed IRA that allows you to buy IRS-approved coins and bars, and they're stored in a secure depository on your behalf. The advantage is you get the tax benefits of a retirement account while holding physical metal instead of paper assets. I put together a free guide that explains exactly how this works, what the rules are, and how to set it up without triggering tax penalties. It's in the description below. If you're thinking about diversifying your retirement savings into precious metals, it's worth checking out. Now, back to what's coming next. The technical picture on gold is setting up for a major move. We've been consolidating between 2,550 and 2,650 for the past several weeks. That's a tight range after a significant rally. When gold compresses like this, it's building energy. The longer it stays in this range, the bigger the eventual breakout. And all the momentum indicators are coiling. The RSI is neutral. The MACD is flattening. Volume is declining. This is textbook consolidation before a breakout. The question is, which direction? And this is where the fundamentals give us the answer. Every piece of fundamental data points up. Central bank buying, physical demand, geopolitical tension, currency debasement, supply constraints. There's no fundamental case for gold to break down from here unless we see a massive deflationary collapse that drives people into cash. And even then, gold held up remarkably well during the 2008 crisis. It dipped briefly and then rallied to new highs while everything else was still recovering. Silver is even more interesting. The gold-to-silver ratio is currently around 88. That means it takes 88 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60. When it gets above 80, silver is undervalued relative to gold. And when gold starts a major bull run, silver typically outperforms by a factor of 2 or 3. If gold goes up 30%, silver might go up 60% or 90%. That's because silver has both monetary and industrial demand. It's used in solar panels, electronics, electric vehicles, and medical applications. As the green energy transition accelerates, industrial demand for silver is projected to increase by 15% annually over the next 5 years. But here's the kicker. Silver supply is actually declining. Global mine production peaked in 2016 and has been trending down since. We're producing about 830 million ounces a year, and we're consuming about 1,100,000,000 ounces. That deficit is being filled by above-ground stockpiles, but those stockpiles are finite. At some point, probably within the next 24 months, we're going to hit a point where industrial users are competing with investment demand for a shrinking supply of available silver. When that happens, the price is going to move violently. I want to tell you about something that happened in 2011 that most people have forgotten. Silver went from $18 an ounce in August 2010 to $49 an ounce in April 2011. That's a 172% gain in 8 months. What drove it? A combination of investment demand and a short squeeze. Hedge funds and banks had been shorting silver, betting the price would fall. But physical buyers kept absorbing the supply. The shorts couldn't cover their positions without driving the price higher, which triggered more buying, which forced more short covering. It was a feedback loop that sent the price parabolic. Now, look at the current short position in silver. The commercial traders, which are mostly banks and large institutions, are short about 320 million ounces of silver on the COMEX. That's 38% of annual global production. If even a fraction of those shorts decide to cover, or if physical demand forces them to deliver metal they don't have, we could see a repeat of 2011. Except this time, the starting price is higher, the supply situation is tighter, and the industrial demand is stronger. The move could be even more dramatic. Let me give you another historical parallel. In 1979, gold was trading around $250 an ounce. Inflation was running hot. The Soviet Union invaded Afghanistan. The Iranian Revolution disrupted oil supplies. Trust in the dollar was eroding. By January 1980, gold hit $850 an ounce. That's a 240% gain in about 12 months. People who owned gold going into that period saw their wealth triple in real terms, while everyone else was getting crushed by inflation. What ended that rally? Paul Volcker raised interest rates to 20%. He deliberately triggered a recession to break the back of inflation. It worked, but it was brutal. Unemployment hit 10%. The economy contracted, and gold fell back to $300 over the next few years. But here's the thing. We're not in 1980. The U.S. government is carrying $36 trillion in debt. They can't raise rates to 20% without defaulting. Every 1% increase in interest rates adds $360 billion to the annual interest expense. At 20% rates, the interest on the debt alone would be $7.2 trillion a year. That's more than the entire federal budget. So the playbook from 1980 doesn't work anymore. The Fed is trapped. They can't raise rates high enough to truly fight inflation without breaking the government's finances, which means inflation is going to persist at elevated levels for years. And in an inflationary environment, hard assets outperform. Gold, silver, real estate, commodities. These are the things that hold value when currency is being debased. Now let's talk about what's happening in the mining sector. Gold mining companies are reporting record profits, but they're not increasing production. Why? Because it takes 7 to 10 years to bring a new mine online, and the capital costs are enormous. A new gold mine might require $2 billion in upfront investment. At current gold prices, that's profitable. But if gold falls back to $1,800, the project doesn't work. So mining companies are being conservative. They're paying dividends and buying back stock instead of investing in new production. This creates a supply problem. Global gold production has been flat at around 3,500 tons a year for the past decade. Demand is increasing, supply is flat. That's a recipe for higher prices. And it's not just about investment demand. Central banks are buying. Jewelry demand in India and China remains strong. Technology demand for gold and electronics is growing. Every sector of demand is either stable or increasing, and supply can't keep up. Silver has an even more acute supply problem. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. If those base metal prices fall, silver production falls with it, even if silver prices are high. We saw this in 2020. Copper prices crashed during COVID, and silver production dropped by 6% even though silver prices were rising. The miners weren't digging for silver specifically. They were digging for copper, and the silver just came along for the ride. This means silver supply is inelastic. It doesn't respond quickly to price signals. Even if silver goes to $50 or $60 an ounce, it might take years for production to increase meaningfully. In the meantime, that supply deficit I mentioned earlier just gets worse. Industrial users start hoarding. Investment demand accelerates, and the price goes parabolic. Here's what I'm watching for in the next 90 days. First, the COMEX delivery data. If we continue to see high delivery requests, that's a sign that physical demand is overwhelming the paper market. Second, the premiums on physical metal. If those premiums widen beyond $50 or $60, that's a red flag that the paper price is losing credibility. Third, central bank buying. If we see another quarter of 250 plus tons of official purchases, that confirms the trend is accelerating. Fourth, the dollar index. If the dollar starts to weaken, that's rocket fuel for gold. A falling dollar means foreign buyers can afford more gold with their local currency, which increases demand. It also signals that confidence in the dollar is eroding, which drives more capital into alternative stores of value. Fifth, geopolitical developments. Any escalation in the Middle East, any moves by BRICS nations to formalize their alternative trade system, any signs of financial stress in the banking sector. These are all catalysts that can trigger a rapid repricing of precious metals. And here's the thing that most people miss. These moves don't happen gradually. They happen in surges. Gold might sit at $2,600 for months, doing nothing, frustrating everyone who owns it. And then, overnight, it gaps up to $2,800 on some news event. Silver might trade sideways at $31 for weeks, and then suddenly it's at $38. The big moves happen fast, and if you're not already positioned, you miss them. This is why timing the market is so difficult with precious metals. You can't wait for confirmation that the move is happening, because by the time it's obvious, the easy gains are gone. You have to position yourself based on the fundamentals and then have the patience to wait for the market to recognize what you already see. Let me tell you about a guy I know who learned this lesson the hard way. In 2019, gold was trading around $1,400. He was convinced it was going higher based on the Fed's pivot to rate cuts and the growing debt levels, but he wanted to wait for a pullback to $1,300 before buying. Gold never pulled back. It went straight to $1,700 by the end of the year. He missed a 20% move because he was trying to save $100 an ounce. By the time he finally bought in at $1,650, the easy part of the move was over. The lesson is this: if the fundamentals support higher prices and you believe the thesis, don't try to be cute about entry points. Get your position established and then add on weakness if you get the chance. Because in a bull market, the biggest risk isn't buying too early. It's not buying at all. Now, what about the risks? What could derail this thesis? The biggest risk is a deflationary collapse. If we see a 2008-style credit crisis where asset prices crash and everyone scrambles for cash, gold could pull back in the short term. But even in 2008, gold only fell about 25% from peak to trough, and it recovered within 6 months. Compare that to stocks, which fell 50% and took years to recover. So even in the worst-case scenario, gold is a relative outperformer. The other risk is government intervention. If gold starts rising too fast, governments could impose restrictions on ownership or trading. We've seen this before. In 1933, FDR signed Executive Order 6102, which required Americans to turn in their gold to the government at $20.67 an ounce. Then, the government revalued gold to $35 an ounce, effectively confiscating 40% of people's wealth. Could that happen again? It's possible, but less likely. The political and economic context is different. Gold ownership is more widespread globally. Any attempt to confiscate gold in one country would just drive capital to other jurisdictions. The more realistic risk is taxation. Governments could impose higher capital gains taxes on precious metals, or they could create reporting requirements that make it harder to buy and sell anonymously. This is why some people prefer to hold physical metal outside the banking system, in private storage, or in jurisdictions with strong property rights protections. But here's the bottom line. The setup for precious metals right now is as compelling as it's been in decades. The fundamentals are aligned, the technicals are coiling, the catalysts are in place, and the risks are manageable. If you own gold and silver, the next 90 days could be the beginning of a move that redefines your financial position. If you don't own any, or if your allocation is too small to matter, this is the time to reassess. Because what's coming next isn't just another rally, it's a repricing, a recognition that the monetary system we've lived under for 50 years is changing. And in that change, the people who position themselves in real assets, in things that can't be printed or debased, are going to be the ones who preserve and grow their wealth. Everyone else is going to watch their purchasing power erode while they wonder what happened. The question is, which side of that divide do you want to be on?